feel like we're getting to a point where there's light at the end of the tunnel.
There has been a lot of buzz. What does this really mean?
I'm going to use the word obsession when it comes to rates right now. You can never time the market.
Will this bridge the gap?
I want to hug you for saying that.
Welcome to the Stellar Talk Show. It's your platform powered by Experts Insights. We're here to explore the questions and topics that matters most to you, whether it's achieving homeownership, investing, or elevating your lifestyle. Let us know what you want to hear, and we'll bring industry experts to dive deep and provide the answers you deserve. Thank you for tuning in. Don't forget to share this podcast with anyone who could benefit from these valuable insights. Let's dive in and elevate together.
Hi and welcome to Stellar Talk Show. It's your platform powered by Experts Insights. Today we are joined with Nicole Farrugia, who's the founder and the mortgage broker at Mortgage Ease with the Wine Group, and also recognized by the Canadian Mortgage Professional as 2024 Woman of Influence. Welcome to the show.
Thank you for having me in that warm introduction, Stella.
You're most welcome. Nicole is joining us today to go through a lot of topics, that's the changes coming up in the market and what does that mean for you. But before that, let's talk a little bit about yourself.
Sure. So I've been a mortgage broker for several years now. Prior to my years in finance, I was actually in legal for aging myself now, but about 18 years. So I actually fell into this industry, but I absolutely love it. And, you know, especially over the last couple of years, we've seen a lot of challenging times for people. So it's really nice because I feel like we're getting to a point where there's, I'm going to say, light at the end of the tunnel. And, you know, things are finally, you know, getting to a bit of a better place. And so I'm happy to be able to share some of the new insights and rules that are coming into place that's going to help us.
That's amazing. Thank you for taking the time to do that with us today. So I have to say, like, you know, after the few mortgage rate cuts that we've been witnessing, and the news about the new changes coming from the federal government, there has been a lot of buzz around, like, hey, what does this really mean? Like, is this the time that we've been waiting for, or like maybe we should wait longer, or like, you know, what is that going to look in the number wise financially? So I just want to, like, you know, take the time to go through all that. So people are educated on what to expect when December 15th comes, and, you know, also like encourage them to have those conversations beforehand so they can make informed decisions.
Definitely. So I'll kind of start by just recapping on a few things. So you mentioned, you know, the various rate cuts that we're seeing. So I just want to sort of clarify, because I feel like there's some confusion around the fact that the rate cuts that we're seeing with the Bank of Canada, I feel like, you know, nowadays everybody knows about the Bank of Canada announcements. Everybody's got it, you know, marked on their calendar.
Everybody's like following that now.
Exactly. So, but with those Bank of Canada announcements, those decreases that we're seeing to the policy rate and to the lender's prime, those affect variable rates only. So I just want to clarify that, because I feel like there is you know, some continued confusion around that. So with those decreases, we've seen several now. There's more expected to come. And you know, depending on who you listen to, there's several economists out there. I have a couple of my favorite, but they're all sort of, you know, leading and pointing in the same direction, that we are going to remain in a declining rate environment. Meaning we're going to continue to see some decreases.
That's great.
You know, and depending on, you know, where we're going to land, I will sort of go on the record and say I don't expect that we're getting anywhere near sort of what we saw in early COVID times, right? We're not getting back to those 2% or sub 2% rates. But I think we can set the expectation that we are getting back to sort of pre-pandemic levels. And so, you know, with the sort of expectation, I want to emphasize as well too that, you know, with all of these decreases to the variable rates, the fixed rates kind of have a bit of a, you know, mind of themselves. They pertain to, or sort of, they're not directly correlated to the Bank of Canada, and they're sort of governed by the bond market. And I'll spare you the details of all of that because we have lots to go through today. But my point in bringing it up is that the sort of shift that we're seeing right now, ultimately what typically happens is that there's a bit of a trickle effect. And what I mean by that is that as we continue to see these Bank of Canada decreases and the variable rates come down, ultimately we expect the fixed rates to come back down as well. But because they're not directly correlated, they don't happen at the same time.
That's true.
So when we're seeing these, you know, 50 basis point decrease that we saw, you know, in October, I had lots of calls calling me saying, hey, Nicole, so my fixed rate went down, right?
Yeah.
And that's not the case. So, there's lots of things happening right now. And I'm bringing this up just because it's so important that, with all of these new rule changes that we're going to talk about and, more, purchases coming to play and all these kinds of things, it's really important that we understand these things because, there's been a lot of, I'm going to say, bad reputation that's followed the variable rates for quite some time now.
Yes.
Understandably so.
Yeah.
But if you kind of understand everything that I'm saying, that we expect that we're in a declining rate environment and, there's a bit of a trickle effect with the fixed rates, then ultimately, a variable rate can still be a very good decision for a lot of borrowers and a lot of clients because, we anticipate that we're going to see, fixed rates also come back down, whether it's, 6 months from now, 9 months from now, at some point in the future. So the nice thing with those variable rates is that you have the flexibility to lock into a fixed rate later on. I feel like there's a lot of, I'm going to use the word obsession when it comes to rates right now because it's true. Everybody's, really concerned about rates. Again, understandably so, but, making sure that we're making the right decisions and picking between the fixed and variable.
Most definitely. And that's a very good clarification that you gave there because that's definitely a question a lot of people do ask, but even sometimes with a minor explanation, it's not clarified properly, right? So I'm glad that you took the time to do that. And also, Nicole, like when we spoke earlier, you talked about the changes that was recently introduced as well. Do you want to talk a little bit about that?
Yeah, of course. So again, lots of different things coming into effect, but the one that we just recently saw as well was with respect to the stress test. And so just to kind of recap again on what that stress test is, the easiest way for me to explain it is that if I were doing a mortgage for you or one of your clients, we have to almost pretend as though the rate that we're qualifying is significantly higher than what they're getting. So very easy example, let's just say I was securing you a mortgage with a 5% interest rate. For the most part, I have to add 2% on that to do what we call a stress test. And that's just sort of, the governing bodies and the powers that be wanting to make sure that, if there was income disruption or things that happen, that there is still
affordable.
100%. Exactly. So I understand, a lot of people say it's a bad thing. It's there for people's best interest.
Yeah,
exactly.
That's true.
So those stress tests are in place regardless of the type of mortgage. But what's been happening now, or what is happening now, is that with conventional mortgages, so mortgages that are not insured, example, you've put down more than 20%, when those mortgages come up for renewal, so when that 5-year term is done, for example, and you're up for renewal, as long as it's a straight sort of transfer or switch, meaning you're just looking for rate shopping and things like that, you no longer have to qualify under the stress test.
Wow.
So it's a really, really big sort of help, and we actually saw the removal of the stress test earlier, I believe it was earlier this year, on insured mortgages. So mortgages that have that default insurance attached to it, but there was still a whole bunch of players that didn't get to take advantage of that. So just to kind of again recap on what that means is with so many renewals, like the most we've ever seen coming up, if individuals and borrowers are looking to just again, rate shop and make sure that they're finding the most favorable rate for themselves, and we're not doing any sort of material changes to the mortgage, then we don't have to qualify under the stress test, which is really nice. So that'll help people quite a bit.
That's true. That's amazing. And also, I just want to talk about, like, when you come to renewals, I know a lot of people focus on the rate itself.
Yes.
And that's their complete focus on. But I think there are other guidelines behind on the mortgage as well that they need to pay attention to.
I want to hug you for saying that. Yes, it's so important, and I can't stress that enough. And these are conversations that I have on a regular basis, kind of going back to, I know it sounds bad, but I keep saying that rate obsession, because it's heavily emphasized and put out there in the media and things like that. That's what everybody is focusing on. And again, we're all feeling it from a cash flow perspective, all those kinds of things. So it is important, but it's not the be all end all.
Exactly.
And it's really important that we're looking at the overall product.
Yes.
Something as simple as prepayment privileges. So the amount that you can pay into your mortgage, that is something that gets overlooked on a regular basis.
That's true.
And there are so many other avenues and things that you can do with those prepayments that will help you in the grand scheme of things. And so these are not things that you want to overlook. And I can't even count how many times I've had the conversation where people are like, oh, I'm not worried about prepayment privileges. I don't have that much in my bank to pay it down anyway. And that's not the mindset that we want to have. So I can't emphasize enough, anybody who has a renewal coming up, speak with your mortgage professional. I'm going to go out there and actually say, please speak to a mortgage agent, a mortgage broker. Nothing negative to the banks, but the banks are familiar with their products and their products only. So it's really important that you have options.
Exactly. When you come to a mortgage broker, you have access to many lenders, including the big banks.
Exactly.
Right? So when you go to a bank directly, they talk about only their product. They're not going to compete and see, hey, are you getting the best deal or the best rate or anything like that. So of course, I completely agree.
Yes.
When you're coming for renewal or you're looking for that new mortgage, talk to a mortgage agent or a broker, because they will be able to shop around and make sure that you're getting the good product. So let's talk about these changes coming up that everybody is waiting to see what is going to be on December 15th, right? So I hear that, it's going to be one of the biggest or the boldest moves the federal government is making after a decade to the mortgage, just to make sure it's more affordable, it's at reach for people, especially the young generation, Gen Zs, to achieve home ownership, right? And, bridge the gap that's currently there, right? So there are a few changes coming up. One is the down payment option, the 5%, and then the cap has now been increased from 1 million to 1.5. Do you want to talk a little bit about what that really means? Because the reason I'm asking is when you say 5% down payment, there's a category that it breaks into, right?
Exactly. It's still the same sliding scale that it was before. So, but the difference is in where it affects the down payment is that there's a higher cap now. So, just to kind of step back a bit, I'll say that these rule changes are in effect for insured mortgages. So just to kind of clarify and recap what an insured mortgage is if we are putting down less than 20%, we have what's called a high ratio mortgage. And ultimately that just means that the borrowers or the individuals will have a default insurance that's rolled into the mortgage. So it's not something that you're paying up front, it's rolled into the mortgage. And that is a percentage, and there's a sort of a scale for that. But so currently, up until December 15th, the cap for that space is $1 million. And so now the cap is now $1.5 million. So to give you some perspective and kind of take that back to the down payment, previously or up until December 15th, the minimum down payment would be about $300,000 on a $1.5 million purchase. Whereas now that's changed to $125,000.
Wow, what a difference.
So very big difference. Now, pros and cons with everything. I just want to clarify again what that scale looks like. So the 5%, because that gets thrown around a lot, where I'm a first-time home buyer and I'm gonna live in the property and I'm gonna put down 5%. It's 5% of the first 500,000. Currently, it's 10% on the amount above that up to $1 million, and as of December 15th, it'll be 10% up to the 1.5.
0.5, yes.
Yeah. So very, very big. Difference in what that down payment is. I'm speaking to people about this, I'm very excited for it. I want to just kind of go out there and say that I'm not suggesting to my clients that, hey, now you can go buy, another $500,000 property if you can, qualify for it. I'm not suggesting that by any means, but where I think this will really help is, depending on the market. So, in areas like Toronto, for example, like actual Toronto or, Markham, Vaughan, like some of those areas, it's very, very possible that, first-time homebuyers are looking at a property that's $1 million. I know it sounds crazy, but that's very possible. I mean, you would know that even better than I do. And so, there were a lot of people that were sort of just, priced out of this market over the last little while because they needed a little bit of wiggle room. So maybe there was a property, we all know that it can be listed at $999, but it doesn't mean that that's the expectation, right? And so it's very frustrating for a lot of borrowers, and you and I see this on a regular basis. We're used to it, but I've had so many clients come back to me with their hearts literally broken because they're like, we just can't get over that gap, or sorry, that cap, I should say. I definitely think there's, lots of exciting things to, come into to play for those borrowers there.
For sure. And the icing on the cake is the 30 years amortization.
Yes. So I'm actually really happy about, I'm happier about that than I am. I mean, it's all good news, but if I had to pick one, it would be that. Yeah. So with the 30-year amortization, it was earlier this year, it was introduced that 30-year amortization was going to be available for essentially pre-construction and new builds.
Yeah.
And if anybody heard me speak earlier this year, I was not happy about this. I was very vocal about it because I just thought it was a whole lot of nothing, meaning that it was almost a tease, right? Because there's just, like, it's great for those, borrowers with pre-construction, but it's just that was not where I really felt the pain point was. So I was really upset about it not being available to sort of all borrowers, or all first-time home buyers. So that is now coming into effect. And so currently in the insured space, we only have a maximum amortization of 25 years. So if you are in a conventional space, meaning not that insured space, we have 20% down payment or more, 30 years is available to all of those borrowers. But in that insured space, again, which are a lot of the majority of first-time home buyers and things like that, it wasn't available. So that's coming into effect. And so we don't get access to it though until December 15th. There's a lot of misinformation out there as well right now that we can sort of apply for it now and close later. But the rule, in order to take advantage of that actual qualification, the submission has to be post December 15th. Yes.
That's kind of like what we were talking earlier as well with clients. Like a lot of people out there think, okay, it's coming in effect, but I want to know what my numbers will look like then. So it's definitely not something that you want to like estimate. You want to wait till the rules to come into effect.
Yes.
Because these are new regulations coming in, new facilities that's made by the federal government.
Yes.
So you need to wait till that time comes to get the actual picture.
Yes, and where I think some of the confusion is like if in a situation, and we actually had a client like this as well too, in a situation where a borrower can qualify under the current rules. So the 25-year AM, all of the current rules that are in place as of today. And if they're not closing till the end of January, for example, we still can at that point sort of restructure it and requalify them on December 15th if they want to take advantage of the 30-year, meaning because that will help with monthly payments and things like that, right? So that we can do, but in terms of basically getting access to it now, we do have to wait. With the 30-year amortization, where that really helps borrowers is it's kind of twofold. So it will allow for a lower monthly payment because essentially the amount that you're borrowing is now being taken from 25-year to 30 years. So it stretches that sort of life of the mortgage out, and it makes the monthly payments literally smaller. And so the qualification that we have to do is such that we take the monthly payments and basically dictates how much the overall liabilities, how much we can qualify for. So with that, it will also now increase purchasing power. So it's kind of twofold, right? Because, again, if we needed a little bit of a boost in terms of, something that's listed, at a certain price and you need to, they're actually expecting $30,000, $40,000, more, we now have that buffer. And the last thing I just kind of want to mention on that is that I've had some questions surrounding, well, isn't a 30-year amortization bad because, we're paying interest for a longer period of time?
Yeah, that's the question that I get asked too,
And what I will say to that is that, with Canadian financing, I think we're very fortunate that although we have, the life of the mortgage being 25 or 30 years in terms of the amortization, we get to renegotiate our terms every few years.
That's
so
true.
On average, it's 5 years. Right now with COVID, we've been seeing some shorter terms, so 3 years, 4 years, whatever it may be. But nonetheless, we get to renegotiate those terms every few years. And so, if we wanted to, we can take advantage and leverage the 30-year amortization right now to get into the market.
Yes.
And then, if Ideally, they would have had a 25-year amortization, and by the time their renewal comes up 5 years, for example, you can catch up. So if you wanted to, providing we can qualify for it and we can afford it, so to speak, we can now renew you and take you to a 20-year, and you would essentially have caught up.
Yes.
So there's so many things that we can do in terms of restructuring it. So I'm just of the mindset that if we can get you into the market, let's do that.
Yeah. And I want to talk a little bit on that, Nicole, because when I'm having these conversations with especially first-time homeowners, or they're trying to see, hey, can I get in? Is this the time that I've been waiting for? To answer the question like this, what is the best time for me to enter home ownership? The only thing I tell them is whatever the time that is best for you. Right? The earlier the better, because housing is at demand throughout history. It's a basic need everybody has. The prices creep, we may have a little bit of dip here and there with the charts up to last 40 years, but you see the arrow is climbing because it's a high demanded a product.
Exactly.
Everybody needs a house, right? And and based on the population growth, there is a gap that the Canadian government is trying to now bridge together with all these new rules and facilities coming in. So if you're asking the question, is this the right time? Can I get in? Have that conversation. Find out if it's within your affordability. Yes. If you have the down payment, go for it. It may not be the dream home that you want with the pool, but it'll give you the foundation to get there.
100%. And I couldn't agree more. And one of the things that I have probably repeated the most in all of the conversations that I've had over the years, and it doesn't matter what's happening throughout COVID, pre-COVID, all of those times, you can never time the market. I'm a firm believer. I believe that wholeheartedly because there's always something, going on. Yeah. And so my answer to all of that is that exactly what you said. The time is right when it's right for you.
Exactly.
And, so again, I can't emphasize that enough. Just have the conversation with a mortgage professional. Do your assessment. Understand what your budget is. You'd be surprised with rent prices the way they are right now, sort of what those numbers look like. It could be fairly, similar to what you would pay for a house. Yeah. And this is absolutely nothing negative to renting or leasing at all. But the reality is, in my opinion, that if you have the ability to pay your own mortgage instead of paying somebody else's mortgage, for me,
why not?
That's a no-brainer. And again, that's not to it has to be right for you. But if you can make that work, because to me, with owning a property, it's literally like taking money from one pocket and putting it into the other.
You're making your money work for you. Yeah.
Exactly.
So even because you talked about leasing or renting, I have to say the rental market is very tight right now. Because with everything happening in the landlord tenancy board, with all the stories that you hear, the homeowners are very, very on top of being secured when they're trying to select their tenants, right?
Exactly.
And because the demand is so high and the supply or the product is very low, there's a high competition. So there are one house for lease and there's about 5 to 10 applications.
Yes.
And they go through every single detail from credit score to employment verification, savings, whatnot, reference checks. So sometimes I feel working with clients, I help them with leasing and also on home ownership. Sometimes I feel buying a home, the conversation is much easier than getting a lease approved because the homeowner demands are so high. Right? Exactly. So there has been a couple of clients who were actually looking for leasing who ended up buying because, it was less stressful for them.
100%, and you won't know what that looks like unless you go through that sort of budgeting and affordability sort of assessment.
And I want to also talk about the qualifying aspects of these new changes coming up. So everybody is asking, hey, I already own a home, does this apply to me? Or I'm in the verge of maybe getting into home ownership, how does this apply to me? Do I qualify? So is there a qualification category, Nicole, that applies to these new changes?
Yes. So in terms of the insured space, so just that $1.5 million cap and that sort of the changes coming into effect under that is for anything any mortgage or any borrower that is purchasing a home with in an insured space, so with less than that 20%.
It doesn't matter if they are first time homeowners or already homeowners upgrading, downgrading.
Exactly.
Okay.
The only only thing that sort of has stipulations is the 30-year amortization.
Okay.
So the 30-year amortization, as it stands right now, is for in that insured space is for first-time home buyers only.
Okay.
So I'll give you an example. Because there's sometimes confusion I find with the fact that I'm a first-time home buyer, so I can put down, the minimum down payment. That is not a first-time home buyer thing.
Yeah.
That is if I am living in the property and it's owner occupied, I can choose to put down less than 20%.
Yeah.
So, example would be somebody purchased a property in the height of COVID. Slightly inflated price points. And now they're selling and buying, and we are using the net sale proceeds towards the down payment of a new house, a new home, but we're looking to upgrade, so to speak. So we're purchasing a little bit higher. So now we no longer have 20% down payment for that new house. It's ideal, and usually when we're selling and buying, we typically have 20% or more. But in this situation, just given the circumstances, we don't have that. Well, those borrowers, that family, can still purchase in the insured space with less than 20% down payment. But because they are not first-time home buyers, they wouldn't get access to that 30-year amortization.
Years. Okay, that's the difference.
Yes.
Okay, and let's talk about new builds.
Yeah.
Like, if for the new builds, they do qualify for that.
Yes, so the 30-year amortization, that was what I was kind of mentioning, was initially introduced for the new builds. And so that's, again, it's great for the pre-construction and the new, and I think that's also because that market's been a little saturated for some time as well too, so they're looking to, again, incentivize, borrowers and buyers for that as well. So yes, in the pre-construction, if it's, a pre-construction or newly built property and not resale, then yes, that 30-year amortization is available.
Yeah, and that's for even if you're a current homeowner, you're investing into a pre-construction, or it's your first home and you're going pre-construction, they both apply.
Exactly.
Okay.
Yes.
That's great. That's
so
amazing.
it will be nice, and the next step, hopefully, I'm going to throw that out there for anybody who's in the regulate, can regulate these things and call the shots. It would be really nice if we have the 30-year amortization just available across the board, but baby steps. We'll take it for now.
Yeah. One step at a time.
Exactly.
Yes. So I want to understand the goals behind why this is happening, why federal government is bringing these major changes after decades, right? I definitely see the population growth in Canada. The demand has gone. The prices, rental prices has skyrocketed, and even we do see a buyer's market right now. It can change with what's going to happen in December 15th. So in your viewpoint, Nicole, will this bridge the gap between the demand and the supply in the housing industry?
I don't think so. I think we're still a ways away from that. I think it's all, steps in the right direction, all, moving in that right direction. But I still think that there are a lot of other external factors that are causing issues. To me, this is not going to fix the supply and demand issue, right?
Yes.
But again, it will help affordability, and it will help, those buyers that have kind of been, forced into the rental market because they couldn't, purchase because of that cap, for example, or needing that little bit of wiggle room with, the 30-year amortization. So I definitely think it's helping, and it's all, again, moving in the right direction, but I think we still have quite a ways to go in terms of the overall housing crisis, so to speak.
Understand, because the population never stopped growing.
Exactly.
So we need to definitely, speed up the process as well to meet the gap. So I wanted to ask you, so with this, in this time frame of the year, with everything happening, the big talk about housing, affordability and what's coming next, and the next interest rate announcement again in December happening. So a lot of things are changing. A lot of people are looking for the opportunities to grasp, and a lot of people are still at the edge, like the penguin theory. I'm going to wait to see what happens. I'm going to follow this. What is one piece of advice that you would like to share?
Honestly, I kind of said it earlier, and I'm just going to reiterate again to say, just don't wait. Don't sit on the fence. I think, if you've had that assessment and this is something that you want to do, I think we still have a little bit of a window before things get a little crazier. And despite everything that I'm saying, or the information that's out there, there are still people that are sitting on the fence and are going to continue to sit on the fence until the next rate decrease or the rules come into effect and all those kinds of things. So, but I do genuinely believe that we're going to continue to see, an uptick in the market. I think it's going to be a busy spring. And I think, all of these changes, again, are going to fuel that activity. And, that window that we may have in certain areas and market centers for, certain people is just going to, kind of disappear very shortly. So I think, if you have the ability to purchase now, don't time all of these changes or, the continued rate decreases. Again, kind of taking it back to the very beginning with the variable rate options. That's something that, again, can buy you time if you wanted to act on something now and then lock in at a later date, right? When you think the rates, have come back down further.
For sure. I just want to throw some numbers at them for them to get thinking. So let's say hypothetically someone who's renting right now want to get into like a 1-bedroom or a studio apartment. The prices are slowly climbing, as we have seen in the near past. Whatever that was in the 450, 430 range is now closer to 500 range, right? The demand has gone up and we can see the prices are climbing already. So let's say hypothetically they're looking for a $500,000 home. The down payment you're looking at is about $25,000.
Yes.
Right? And what does the closing cost would look like?
So that's a really good question. It depends on, the answer that depends on who's asking. And what I mean by that is if you're in an insured space, an insured mortgage, the lenders themselves will typically ask to see about 1.5% of the purchase price for the closing costs.
And that is on top of the down payment.
Exactly. But in reality, for that same example, the closing costs will actually be much less than that, just simply because of the first-time home buyer land transfer tax rebates and things like that. Because in the Toronto market, they're double taxes for the land transfer tax, but you can get a maximum credit of $8,475, I believe it is, and then outside of Toronto, it's $4,000. So those rebates will get applied to the land transfer tax, which is the biggest portion of your closing costs. So in reality, it's less than that. But in the conventional space, so sort of regular mortgages, not in that insured space, I typically will say anywhere from 2 to 4%, because it will depend on the area that you're purchasing as well. So again, Toronto is going to be closer to that 4%, where somebody in Oakville, for example, is going to be maybe on that 2%.
That's true.
So it depends.
So it's good to talk about the actual numbers, because a lot of people, they may or may not have that $25,000 to $40,000 amount in their savings or in their RRS space, but this is the time that you can sit down with a financial advisor or a mortgage advisor to see how you can put that savings to play.
Exactly. Right? And that's why it's never too early to have those conversations, right?
Yeah, and we see a lot of inquiries these days. We've been doing a lot of meetings as well, and we encourage you to bring them on. We are happy to sit down and have a look at your numbers, your goals, what you want to achieve in your home ownership, in your life in general, and see how we can get you started and give you the best advice. And maybe even you don't have the savings right now, maybe you can come up with a plan.
Exactly.
So at what time we should have the next conversation. Right, and that's the goal, that we want to have this discussion today, so people are aware of what options are available for them. And with all the questions that you had, I hope that those has been answered for you. But if you do have more questions, we're gonna leave a link below in this podcast, so you can always reach out to us. We'll be happy to schedule meetings, sit down with you, and talk about your future, your goals, and how we can maybe able to assist you get there.
For sure, definitely.
Yeah.
Happy to help.
Yeah, Nicole, I want to thank you for taking your time, coming here, sharing this insightful information. Yeah, and we look forward to maybe having you again another time.
Yes,
with
definitely.
More insights into a different topic onto mortgages.
Of course, and anything that you guys want to know, let Stella know, and we'll be back here for sure.
Most definitely. Thank you, Nicole. It was a pleasure having you.
Thanks again. Bye, guys.
Thank you for spending your time with us on the Stellar Talk Show. We hope you found value in today's episode and gained insights to help elevate your lifestyle. If you enjoyed the discussion, please like, subscribe, and share it with anyone who could benefit. It means the world to us. Until our next episode, stay inspired, and I'll see you soon on our next Stellar Talk Show.